just to sort of take you through scenario analysis and sort of what's the best way to tackle that and how we generally sort of approach it from an investment banking perspective. So I've got set up this very, very basic template. We can go into more detailed financial modeling approaches in a later video, but for the moment, just for the purposes of showing how we sort of tackle scenario analysis, I've just set up this spreadsheet here, and we're just going to sort of go through testosterone sales, made famous obviously by More Plates, More Dates. Shout out to Derek. And just to see what's the best way to model and perform different types of scenario analysis for the purpose of forecasting and modeling that we typically see in IB. So let's just jump straight into it. Let's just sort of make a high level assumption around the units sold. So let's just say we've got 100,000 units. And we know from Derek's website that the sort of regular retail price for testosterone is $59.99 US. And gross profit margin is something that obviously has the actual cost of the product involved, but also there's fulfillment, delivery, labor that's involved in bringing the product together. So let's just make a sort of ballpark assumption. Let's just go 35%. And then we've got operating expenses here in year one. We'll just use some round numbers here. So we'll just say roughly, let's just go $1 million. Just tidy up any signs there. And then the distinction between these operating expenses and the variable side of things may be more related to, say, marketing costs or things that are much more closely related with revenue and unit sales. So this might be, cost to acquire or things like that. So let's just assume that we're sort of at 10% of revenue. This would be effectively our opening inputs there. So if we scroll over to the right a bit, we've got our FY22, which will be our opening units. Let's just tidy up that as we go, just for our opening period. So revenue, what effectively we'll have here is just simply the number of units sold multiplied by the price per unit. So there we go. We got 5,999,000. Let's just tidy up our signs here as well. Please fix myself. Thank you very much. And then the cost of goods sold is going to be effectively 65%. So let's just tidy this through. Equals revenue times 1 minus our gross profit margin. We can lock that cell. Now we've got to take that off. Boom. So effectively, that's our gross profit margin of 35%, bringing through GP of 2.1 million. Now, around our operating expenses, which are fixed, we're just going to assume they're $1 million for the first period. Might move myself down a little bit there. And then the variable side of things, we'll just do that times our revenue number. I'm seeing through there. So that has to come off. So that's a negative there. So in our first year in FY22A, using these very high level assumptions, we're getting reported EBITDA of 500 grand, which is effectively an EBITDA margin of 8.3%. Not terrible, but nothing to write home about just yet. So now the whole purpose of this is we want to be able to sort of flex assumptions going forward into FY23 and then to FY26. So let's just assume our base case is effectively just CPI. So let's just put in 2.5% across. And then let's say our downside case, we're not going to grow. We're going to go less than, effectively what CPI is, so 0.5%. Upside case, maybe we go very well, just because Derek's doing amazingly right now. So he's growing at 8% in FY23, 5% in FY24, say 4% in FY25, and cascading that down. Now, the thing to remember here is that you might want to have 8% flat for all the periods, but as you grow, as your business gets scale and grows and acquires more customers, sells more units, it becomes more difficult to incrementally grow that same percentage point. Now, around margin, let's just assume the base case improves slightly. So we've got, obviously right now, there's a lot of issues with COVID around supply chain and freight, which have pushed down gross margins. So let's just assume, say, 40% going forward. Things stabilize a little bit, 40% there. And let's just assume some round, rough numbers for the downside case, where margins continue to deteriorate and then stabilize. And then upside, we go 42.5%. There we go. Now, fixed OPEX growth, let's just assume maybe we're increasing by CPI. And obviously, when we build an actual fully fledged financial model, this is a lot more sophisticated and there's a lot more thought that goes into it. But these are just sort of the high level things that we try to bring it back to in terms of KPIs, just to sort of assess the reasonability of what we're modeling. Now, variance, in terms of variance, but should be variable. Really should have run a spell check on this before I filmed it, but all good. The base case, we've got 10%. Let's just assume that continues on. Downside, let's just assume that OPEX actually increases 11%. And upside, maybe we get some minor benefit in the outer years as we get economies of scale, and we can just run that through. So maybe we get, I don't know, let's go maybe 8% here. 9%, increasing slightly. Boom. So there, what we've got here is effectively our different scenarios for our base case, downside case, and upside case. But what we've got to do here is flesh out the different flags and different options here. So this is effectively what our scenarios are. So 1, 2, 3, we've got base, downside, upside. What we want to do here right now is use drop-down flags, because that prevents a lot of potential for error. If you get a workbook where someone's misspelled, they might have spelled, downside case or whatever it might be, and that just absolutely ruins everything. So what you want to do is you want to really lock the actual potential inputs there. So then we want to go to data and then effectively go to data validation. So we want to go data validation on this particular cell, and we want to allow a list effectively between these items here. Click through, boom. So now we click in, boom. We got base. Let's just tidy up our formatting here. We got base, downside, and upside. So that they're effectively what our scenarios are limited to. We can only choose one of these three. And if we fudge it up where we had bad spelling or something, then the calculations are still going to work there. So now we can hide this down. Boom. So now what we want to use is index matches here. So the best way to do this is to think of it as, what do I want to return in this array? So for FY23, we want to return these figures here, but we want, when we drag it across, we want it to be able to slide. So we want to lock the rows only, not the columns. So that's what we're pulling through. And then match, we want to look up base case in this array. And then this is where our lookup array is. Lock that as well. Boom. So that's pulling through 2.5% for FY23 based on our base case. So we can just drag that across. And a way to sort of quick fire sense check this on the fly is to just fudge with that, and then that changes there. So it's pulling through 3%. So let's just reverse that. That's what our growth percentage is that we're going to apply. And then what we can do is we can just drag this down. And then we want to get our gross margin percentage of revenue. So we can just drag that array down, drag that across. And same here, because we want to pull it on prior year growth. So we bring that through on our fixed OPEX. All right, I might be a little bit slow because I'm looking around a giant microphone when I'm trying to pull this stuff through. So apologies, everyone. Now we want to take this down to variable OPEX. There. Boom. So this is our scenarios that we've got for each of these different buckets in terms of revenue growth, gross margin, fixed OPEX. And when you are building a fully fledged dynamic model, the possibilities are endless in terms of the different variables you can put on it and how detailed and granular you want to be. But this is sort of the basic fundamental principles in terms of pulling it together. So now from here, we can use our prior period, D10 plus 1 plus, and we want to apply our growth rate. And then we can just drag this across effectively. Now, a great way to sense check is to have KPIs already built in. So now we know just straight away that revenue growth 2.5, 2.5, 2.5 is indeed our base case. So now COGS can literally just go revenue E10 times 1 minus 40%, which is our margin. And that to be going the other way around. And this, again, straight away we know this is correct because our gross margin per our KPIs is 40%, which is pulling through the right number. And then we want to pull through the same one for OPEX. And we can just drag that across. And variable, simply percentage of revenue. And then we need that to be an expense coming off effectively. And once you've done this, all very well and good, but what you need to do is sense check the KPIs and the assumptions that this is pulling through correctly. So our variable, straight away we know that's right. Fixed OPEX growth, straight away we know that's right. Gross margin, we know it's 40% per our base case. So all of that is making a lot of sense. So in our scenario analysis, and we can use this data for charting and everything, if we want to see what our EBITDA is. So per our base case, just mix that in as values. And then we can simply go downside, boom. Is this calculating correctly? Yes, because it's 0.5 here, 32.5% there, 3.5%, 11%. And we can see straight away that that's all making a lot of sense. So then we can do that and just hard code that in as well. Obviously, I doubt the downside is actually going to be reality for Derek, but this is obviously just a pretty high level exercise to pull things through. Boom. So now we should specify here that this is EBITDA as reported. And generally when we're modeling, we've hard coded things, like everything is typically dynamic. So there are no hard coded inputs or hard coded outputs rather. Our inputs are the things that are hard coded. So where we have hard coded items and where if we change things within the model that will need to be updated at some point, then what we need to do is to specify that and make that as clear as possible for a reviewer, because that's the easiest way to get a police fix and to piss someone off is to do that in a shoddy manner. What we can do here, we can maybe do some charting or whatever it might be, just in terms of perhaps a line chart or a stack or a clustered column chart's the best way to go about it. But that's effectively sort of the fundamental principles that we adopt in terms of setting out different scenarios. And you can obviously set this up in a different type of table or row or column type table or whatever you please. But that's the fundamental principles to build in some scenario analysis. So I hope everyone enjoyed that. Like and subscribe if you want to see more of this content, and I can do more deep dives and put all these templates out later if that's something that people would like. Thanks, everyone. Have a nice day. Bye.